and welcome to Taking Stock for the week ending 30th of September. My name is Jason Yin, and joining me today is my colleague, Daniel Ortisi. Welcome back, Dan. Good to have you on after last week's long weekend.
Yeah, thanks, Jace. It's great to be here for another week of Taking Stock. And just before we get started, as always, the information provided today is of a general nature and therefore should not be considered personal advice. Shares are volatile, so any charts and tables presented should not be relied upon as a guide for future performance.
Great. Well, Dan, market volatility again reached extreme levels this week after the US Fed lifted interest rates by 75 basis points. While the increase was within market expectations, investors were a little bit jolted by the Fed's hawkish commentary, which effectively signaled more aggressive rate hikes in the near term than what was previously priced in.
Yeah, that's right, Jason. It's such a tricky market to navigate. Over the last 10 years, investors have really been rewarded for buying the dip and following that strategy. And the question is now, when does that strategy stop working, given we're entering a period of interest rate rises and therefore no longer really receiving a free kick by central banks? Additionally, we've seen the market move occasionally really high to the upside, which of course adds to the complexity and confusion for investors who may risk moving a move higher.
Well, that strong upside move occurred on Wednesday nights when bonds, equities, and commodities all ripped higher. Part of the positive sentiment came from the Bank of England's decision to rescue the bond market by pledging an unlimited bond buying program for longer dated bonds. That had a ripple effect through the broader market and saw the British pound rebound strongly against the US dollar. We will discuss currency market impacts in greater detail later in this episode.
Yeah, and I suspect, Jay, that it's likely that this kind of pinball action that we're seeing will likely persist over the near term as both bulls and bears continue to go head to head.
Yeah, that's a good point, Dan. Look, I think from here, it's a timely reminder for members to retain a well-diversified portfolio of at least 15 stocks. And this aims to minimize company-specific risks. And if you're an investor who manages risk using technical indicators such as Lincoln's SD Max or SD30 TSR, then be prepared to act when the trends change.
And furthermore, Jace, it's also imperative to lay out your investment framework in volatile times and make sure that you stick to it.
All right, let's shift our attention towards some of the company updates this week. And first one off is borderline star growth stock Santos, who received an offer from Papua New Guinea's national oil and gas company, Kumul Petroleum Holdings, to acquire 5% of the PNG LNG project for $1.4 billion. Santos is set to retain a 37.5% exposure. Now, the offer price also includes $0.3 billion of debt, which will be removed from Santos's balance sheet.
Yeah, and for further reference, the Papua New Guinea LNG project is Santos's largest producing asset and is therefore forecast to deliver 40% of group's oil and gas production for FY22. The proposed transaction will have an effective date of the 31st of December 2022, with Santos retaining all of this year's earnings and cash flows. Given that, we do not view the sale as having any material impact for FY22 and potentially FY23 earnings.
Another company to announce this week was Premier Investments. The company's a Star Growth and Star Income stock, and they announced its FY22 results. Performance over the period was above consensus expectations, and earnings growth was well supported by an expansion in gross margins. This should help the company's ability to maintain a stable return on equity and also net profit margins.
Yeah, and furthermore, Jace, it seemed like the market was quite impressed with the company's announcement of a special dividend, which brings the full-year distribution to around $1.25, or an implied gross yield of around 8%.
Yeah, on top of that juicy dividend was a $50 million on-market share buyback, which is pretty small at 2% of its market cap, but still a nice cherry on top of the strong result. What it also does is it positively signals that management may believe that the share price represents a little bit of opportunity at these current levels.
That's right, Jason. Moving on, another company to make news this week was ex-borderline star growth stock Cogstate. To provide members with a quick recap, we ceased coverage of Cogstate earlier this month based on the following factors. One was due to the rapid decline in return on equity, which is a function of the material lift in its equity balance. And two was based on a significant drop in the company's average daily liquidity to fall below $200,000 of trade per day. On Wednesday morning, its share price popped over 50% on basically no news. And Jace, could you just provide a bit further insight on why this was?
Yeah, look, that's a good question, Danny. Cogstate's Japanese partner, Eisai, announced positive phase 3 trials of its experimental therapy to treat Alzheimer's disease. I think the extraordinary price move even surprised management because Cogstate's agreement with Eisai relates to digital brain assessments in the healthcare market, and this excludes clinical trials market. However, positive phase 3 trials data from Eisai may be expected to lead to perhaps a general increase in research and development expenditure in respect to Alzheimer's disease. And this could provide additional sales opportunities for Cogstate, but any upside is unquantifiable at this stage.
And we should also mention that its low level of liquidity did play a big part in the price move, and it's likely to remain volatile in the short term. We may revisit Cogstate at its first half 23 results, so continue to watch this space for the company.
Thanks for that, Daniel. On to the corporate calendar, and it seems like it's a pretty quiet week ahead, with none of our star stocks reporting and none of our income stocks going ex-dividend. All right, now in Under the Microscope this week, we focus our lens on star income stock Coles Group. The company is the nation's second largest grocer and offers investors exposure to the defensive consumer staples industry. Approximately 87% of Coles' total revenue was derived from supermarkets, 10% from liquor, and around 3% from Coles Express. The Coles Express, or the convenience business, has proved challenging for Coles over the past several years. So, Danny, why are they divesting the segment now?
Well, Jace, as you said, Coles Express has been a drag on the group's performance, especially over these past 2 years, as COVID restrictions saw a significant slowdown in the volume of fuel sold. For reference, Coles Express delivered approximately 70 million litres of fuel a week pre-COVID, which has now dropped to around 55 million litres. Exiting this business would allow the group to strengthen its focus more on the significant supermarket and liquor businesses.
Right, and it seems like the sale price of 300 million, or approximately 4 times forward earnings, does not seem that attractive, but it will free up approximately $800 million worth of lease liabilities, or which is around 9% of the total, and this would come off its balance sheet. So with the lease liabilities coming off, it should improve the group's total liabilities to total tangible assets ratio, as well as improve its financial health rating.
That's right, Jason. Furthermore, the Coles Express business only contributed around 2% of total earnings. Therefore, we don't anticipate any material earnings impacts from the sale, and this transaction is expected to conclude in the second half of FY23. Furthermore, Coles' dividend should largely be unaffected and continue to provide an attractive source of income for investors at around a 6% gross yield in FY23.
For members who follow technical indicators, Coles is currently bearish on the SD Max and is trading at around a 10% discount to consensus valuation. Highly trend-sensitive investors should remain on the sidelines until a more favorable price trend emerges. Pleasingly, the company's CEO, Stephen Kane, has accumulated some stock over the past couple of years, but retains a modest skin in the game at 0.05% shareholding. Question of the week, we ask how currency movements can impact star stocks. This is topical right now given the current state of currency markets and the British pound almost reaching parity with the US dollar this week.
That's right, Jason. Just to take a step back firstly, well, companies domiciled in Australia typically report their financial figures in Australian dollars, and this is known as the functional currency. However, when a company has operations in a foreign country, revenues and earnings from that foreign entity must be converted back to the parent company's functional currency. And this is what leads to something known as a currency translation impact.
Right, okay. Well, an easy example for members to follow can be seen in Star Growth and Income Stock BHP Group. We can buy shares and receive dividends in Australian dollars. However, the vast majority of BHP's revenues are exposed to US dollars as they transact in USD in the iron ore markets. Therefore, we, as Australian investors, benefit when the US dollar is experiencing periods of strength because that means every US dollar will translate to a higher Australian dollar.
That's right, Jace. And also it's important to point out that the inverse can occur as well. So if the Australian dollar is stronger than the USD, BHP's earnings and dividends in Australian dollars, holding all else equal, would be lower. Therefore, currency movements can have a significant impact on how we as Australian investors, number one, receive dividends, and number two, benefit from overall returns.
All right, so let's move back to the current situation of the currency market. Since the pivot by central banks to raise interest rates and reduce its balance sheet, we have seen the USD strengthen considerably as the US dollar index has risen over 15% in 2022 to a 20-year high, as shown on screen. Now, the strength in US dollars is driven by the pace of interest rate rises by the Federal Reserve, and this has pushed the returns offered by financial products which use dollars, such as US government bonds. This has driven significant increases in demand for the US dollar, which is also seen as a safe haven asset or currency.
That's right, Jason. In contrast, the British pound has fallen considerably this year, and this follows turmoil on its local energy market and also its local economy, which has caused the British government to recently pivot on interest rate rises and introduce tax cuts and subsidies, which will result in additional government debt. Investors have subsequently sold billions of dollars in UK bonds in response to this, which has caused significant pressure on the pound. From our point of view as investors, star stocks with business operations in the UK will be impacted as UK revenue will be translated into fewer Australian dollars, holding all else equal.
So we've provided a lot of tools for members to search for any currency impacts, and you can utilize our 9 golden rules page. And if you refer to golden rule 7, here you can grab a snapshot of a company's geographical exposure. Some of the companies and some of the star stocks with operations in the UK include PWR Holdings, Macmillan Shakespeare, Macquarie Group, Objective Corp, Premier Investments, CSL, Technology One, and Jumbo Interactive. Now, you can also learn about currency impacts under the active risk section. All right, so thank you so much for your input this week, Daniel. It's been an absolute pleasure.
As always, thanks, Chase, for having me on. And it's always a pleasure to present to our members. And as always, please feel free to get in touch with the Analyst team if you have any further questions. Now, if you enjoyed today's episode and are looking for more educational tools, then consider joining our Lincoln live sessions every Monday, where we talk about market strategies and answer your questions on stocks.
In next week's episode, Kim will be back from his holidays and he'll be joined by Lincoln's Managing Director and Chief Investment Officer, Tim Lincoln. In summary, we live in unprecedented times, and the market can experience wild swings both up and down. Therefore, stay disciplined to your investment framework and manage your portfolio risk according to your objectives and life stage. Take care, everyone, and have a safe and healthy week.